Good afternoon, everyone. Welcome to NBO's interactive session. Today, we're here to discuss the 2023 financials. We have Abdullah Al-Hinai, our Chief Executive Officer, Kiri Vertachari, our CFO, and Mr. Balaji and Ms. Aisha from Investor Relations. Abdullah, you can start.
Assalamu alaikum, everyone. Thank you very much for taking the time and joining us for this presentation. As mentioned by Ms. Jawahir, our presentation will be focused on National Bank of Oman's performance during the year ending 31st December 2023. With your permission, we're going to start with the first slide on key messages.
If the sound is not clear at any point, please just type in the chat.
So very similar to the messages that we've been conveying the past 3 years now since we embarked on our journey. NBO is blessed with a very strong shareholder base who provide knowledge, provide financial and non-financial support to the organization. So a highly valuable set of shareholder base. Commercial Bank of Qatar own close to 35%, while the Suhail Bahwan, or Sheikh Suhail Bahwan in particular, own the 15%. And then other institutional investor, in particular SPF, the social protection, the newly established social protection fund, owns quite a significant shareholding in the bank. As we would have seen from our financial performance, we've embarked on a journey of transformation, and alhamdulillah, after 12 consecutive quarters, we've demonstrated strong and growing franchise. Last year, we've celebrated our 50th year in existence, being the oldest locally incorporated bank, where we have strong long-term relationship with prominent private sector, government, and other entities, including individual. A strong management base. Since 2021, we've been building our management team, and this new team brings a collective experience of more than 100 years in banking. Like we had presented in the past, our 5-year strategic roadmap continues to be very relevant, and I'm going to talk about the key pillars that I always present in the next slide. The performance of, back to the slide, please. Yeah. The performance and the execution of this strategy that we started in 2021 continued to be successful, touching and hitting every KPIs that we've committed to. And we continue to believe that the existing strategy is very relevant given the scenarios and the environment that we are operating under. A very sound economic metrics. This is the environment that we are operating in. There is a positive sentiment given the rating action taken by rating agencies last year, and the expectation of hopefully re-entering into the investment grade rating club as soon as probably end of this year, inshallah, and maybe earlier. Technology and efficient digital offering is another key strength and key enabler for NBO. There has been a very significant investment in technology to offer customers different digital experiences, and we continue to be committed to this investment, where we clearly see a very clear return and clear demonstration of the benefit of our investment in technology. Next slide, please. People who have been tracking us for the past 3 years would be very familiar with this slide. As I mentioned, this is the key slide that summarizes our strategy. We strongly believe after 3 years of consecutive positive performance that this strategy has been validated And we also strongly believe that this continues to be very relevant for the next at least 2 years of the life of the strategy. So our priorities has always been to safeguard in terms, given the uncertain condition, both locally, regionally, and globally. So key priority for us is to safeguard the financial performance of the bank through managing liquidity, including interest rate risks that are there, ensuring adequate capital there, and ensuring that our underwriting strategies and tactics are of high quality, and ensuring that any potential deterioration in asset is well recovered as early as possible. Our next priority after safeguarding the financial performance of the bank is the value creation, and that's through enhancement of revenues, be it on the net interest income level or the non-fund based income side as well. And again, our strategies over the past 3 years have clearly demonstrated the success, and we believe that there's further room for improvement and enhancement in there. On the optimization side, we continue, as I mentioned, we continue to invest in the right place, be it on the technology, be it on our infrastructure, both physical and digital. So we believe that optimization is not cost cutting, but spending money in the right place. And you can see that very clearly in the performance of our cost to income ratio that has come down from approximately 55% end of 2020 to around 42.5 end of 2023. Another strong belief and avenue of value creation is partnership. This has helped us over the past 3 years building strong relationships with customer base, non-customer base, and you would see us at the forefront of being the first port of call for many of our stakeholders because of this philosophy that we've adopted over the past 3 years. After the value creation, definitely the sustainability and ensuring that the performance continues. And that's done through building a very strong brand, not simply a marketing tool, but rather ensuring that we know what are the type and niche of customers that we can serve, and being also disciplined to know that there are certain group of customers that maybe either from our own skill sets or risk appetite might not be able to serve appropriately. Digital channel is the second element under the sustainability piece. And like I mentioned, we've invested in this channel, and we continue to invest in the digital side. And finally, but not last, is our people pillar. And again, we've been investing in the quality and the development of our people. This is in summary the key strategic priorities and directions and pillars of our 5-year plan. And I want to reiterate for the third time, we strongly believe the relevance and importance of this, and will continue to be building our approaches in the next 2 years based on these 3 priorities and 9 pillars of our strategy. With that, I'll end my area and section and request the CFO to take us through the financial performance, and then we are open for any Q&A that might be there.
Thank you, Abdullah. Good afternoon, everybody. Assalamu alaikum. So I've got a few slides around the financial. So this, given we are all in Oman, all of you on the call understand Oman's economic overview and the slides there. So with your permission, we'll straight away go into a slide which is called Key Financial Highlights, please. These are all about NBO, and this is the slide that I wanted to talk to, right? And these amounts are in US dollars. We are very pleased with our performance in 2023. As the CEO mentioned, we have a clearly laid out 5-year strategy plan, and we believe we've executed well during 2023 on this. Okay, so what are the highlights then that I want to call out? a number of highlights. First is our profit for the year, net profit for the year was 150.7 million, up 20% year on year. This is one of the highest increases in the banking industry here in Oman. So very pleased with that. This is contributed by top line growth. Our overall our income grew 5.5%. Our expenses grew 2.3%. We try and have demonstrated over the last 3 years that we will grow our income faster than expenses. Having said that, going forward, you should see periods where we are managing our expenses, particularly as we invest in technology and our people. So the last 3 years we've tried to grow our income faster than expenses. First call out. As a result, then you see that I talked about the interest income growth, 6.8% growth, and fee income grew too. So albeit moderate. So net 5.5% our income grew. Then comes the cost piece. I have said over the last 3 years that we are optimizing our cost. We do not believe in cutting out costs. We distinguish between what is good cost and bad cost. You see us more visible in the market. You see us investing in technology and, more importantly, in our people and infrastructure. So, but despite that, our cost income ratio for 2023 was 42.4%, decline over the past year. But also now, as the CEO called out, when we started on this journey, it was about 55%. Then comes the third item in the P&L, which is the impairment line. We see that our loan book has grown, but later in the slides you see the segmental breakdown of our loans, and we've grown particularly well in the GRE segment. We have a very robust risk appetite framework, and we stick to the framework. Obviously, the result of that is a lower impairment charge as well. Then you see that on the balance sheet side, we have both loans and advance deposits growing. The loans grew 4% year on year to 9.5 billion, and deposits 17%. Clearly, the deposits grew faster than loan base, but there are reasons. In December, we had some unexpected prepayments of our loans, number one. And secondly, as I've said before, we believe in being well capitalized and liquid, and the balance sheet matrices reflect some of that. If you look at our total asset growth, it's robust. But you look at the loan growth, particularly in the last quarter, then it was lower, and that resulted in a lower growth for the year compared to our deposits. Then you see very robust Basel III framework, both ratios, both on liquidity and stable funding. Both our LCR and NSFR reflect the fact that as of 31st December, we are liquid, and we remain liquid throughout the year and beyond. Last but not least, our capital adequacy ratio at a healthy 16.9%. This again is an area that we've called out before. We believe in the strength of our balance sheet, which is liquid, well capitalized, and growing the bank in a robust manner, taking in the medium to long term. We don't take a short-term approach to growth or cost management indeed. That primarily is the financial highlights, right? Then if you look at, I've got detailed slides on each of them. Depending on questions, we can go into the operating performance. I've covered a number of these items, but just on the right side, just one thing before I open up for a little bit of question and then take further details, is our cost income ratio. You see that coming down, which we called out. On the other hand, you see the return on equity. We finished the year at 8.8%, which is a good metric for us. We'd like that to improve further, and we will work on that. But you see that return on assets, has again 0.49% to 1.27%. It's improved, and our NIMs have been robust at 2.7%, despite the increase in cost of funds, which is pretty significant in the fourth quarter of 2023. So that covers the operating profit, operating performance. I've already touched upon some of the balance sheet matrices. Happy to go through them in a little bit of detail should we have questions. And then we've got slides around the asset quality, etc. But I'll pause here and sort of take some comments or initial reactions and then deep dive, please.
Any questions so far? Okay, I
Yeah.
think we can
We'll
move on.
continue.
Yeah. So if we can go on to the next slides, then we can very quickly complete that. So asset quality is our next slide. When we talk about the loan book growth of 4.2%, we have a diversified portfolio, and you can see the breakdown between the stage 1 to 3 provisions. Again, these are in a very robust place. Why do I say that? You look at the NPL ratio. NPL ratios have decreased from 4.9% to 4.5%. Coverage, provision coverage ratio, etc. Again, going up on the right side, you see the table below. You see the NPL coverage ratio at 99.5%. Again, up from 93.4% at the end of the previous year. Also, I want to call out the breakdown of loans and particularly loan growth. You can see through this that how our sectoral breakdown of loans is. Our focus has been on the GRE segment. So you see that that segment continues to grow as well. So again, healthy balance sheet, not only in terms of capital liquidity, but also asset quality. As the CEO called out in the 9 pillars, this also continues to be an area of focus for us. You can go to the next slide. So I briefly touched on the capitalization, funding, and liquidity, but these metrics are here now for you to see in terms of liquid assets, in terms of capital breakdown, etc., and the deposit mix. So if you look at current deposit mix, the CASA ratio, etc., obviously the CASA ratio is down because we shifted some of the more expensive CASA into term deposits, and the result of that management resulted in the NSFR increasing to 115.2%, while still continuing to maintain a net interest margin. Similarly, liquid asset ratio 24.6%, and high HQLA at 384%. Capitalization I covered, and CET1 ratio at 12.1% is well, above the regulatory minimum that's been set by CBO. So to sum up this slide and the previous slide, we are in a robust position in terms of asset quality, capitalization, liquidity, and funding. The last couple of slides talk about the breakdown of the balance sheet. I won't cover that, but they provide you a breakdown of the balance sheet and the P&L. That's really what I wanted to cover. To sum up, 2023 was a year of robust financial performance for National Bank of Oman. We increased our profit by over 20% year on year. We continue to be liquid. We are well capitalized and are in a good position in terms of asset quality. That's really what I wanted to cover. I'll pause now and take comments and questions, please.
We are open for any questions.
Hello.
Hi.
Yes, hi. Good afternoon, everyone. This is Neetika Gupta from Ubar Capital. So first of all, I would like to congratulate you for a great set of results. And, we've seen how far NBO has come. The financials really reflect the effort that the management team has been putting in. So I have 2 questions. The first one is, I just want to understand what is your outlook on the loan book growth. There has been a significant push on, development projects across Oman. So how do you think, what is the kind of growth? Just to get a sense of how you are looking at it, how it would pan out, going out to say in the next 3 to 4 years, how you are seeing the growth that is coming. Secondly, my second question would be on the cost to income ratio. Significant improvement there, agreed. But what are the long-term aspirations that the management has? And, what could we expect? I mean, is there something that we can expect that could come even more? And what would be, what would be your outlook on that? Thank you.
So this is Abdullah. I'm going to start and then request Giri to follow through. So if I take you back last year, there were 2 competing factors in terms of the loan growth and loan book, and that's an input or and a key element for us in terms of what our views for 2024. Although we don't give guidance in particular, but just in terms of what our thought process is. One, last year, we've started seeing very positive traction in terms of the loan opportunities. In particular, on the GRE side, but also there was this other element of the repayment, which is a public announcement or public strategy of the government of Oman to repay debt. So we've seen repayment of debt coming in virtually every quarter end, basically. So that was a bit of a contradictory kind of forces. One, growth opportunities, but then also heavy repayments coming in. So that was challenging. Of course, this is a whole banking sector issue, not an NBO in particular issue. Going forward, I think we're very optimistic in terms of the opportunities that are there. You are aware of many of the key infrastructure projects, especially on the smart cities, the green energy, and we've seen already a number of consortium winning concessions on that front, on the renewable side as well. So we see a lot of these opportunities being floated around, and we are very optimistic in capturing, because we've set ourselves, and in particular align, or I'll take you to the partnership pillar, where we actually partnered with a lot of these GREs in many aspects to ensure that we are part of any lending or business opportunities that are there. But not only on the corporate side, but even on the retail side, we were one of the few signatories to the ISKAN project, which is a project that Oman Housing Bank and Ministry of Finance have launched a couple of months, towards the end of last year, a couple of months ago. And we see a lot of opportunities there to work and partner again with Oman Housing Bank and participate in some of those opportunities. So there are multiple opportunities for loan growth. Definitely, it's very difficult to put in a timing perspective. When will we see these materialize? But we believe that 2024 will demonstrate certain growth there. Are we ready? I think from a liquidity perspective, like you see, our deposit growth has grown faster than last year, or faster, sorry, than the asset side. So it gives us enough room and ammunition in terms of our liquidity position. We are working on the cost of fund element. So I think, again, we could be potentially competitive on that front. The third element is on the capital. And that's the key reason why capital is also part of our strategic pillar, to ensure that we have the right capital in place. And we've sought an approval from the shareholders in 2022 for a $300 million AT1 issuance. We've only exhausted approximately 135 million out of that. So we still have room for topping it up. The only reason why we didn't do that, because we were not comfortable with the pricing at that stage. So whenever we need, we still have that channel for enhancement of capital, plus a very prudent dividend and distribution policy that we have to ensure a balance between rewarding our shareholder base, but also ensuring that the franchise has a strong capital base for any growth potential. Giri, anything?
Yeah, no, I think you've covered everything well. Thank you. Thank you, Nitika, for the question. Do you want to add a little bit on the cost-income ratio?
Maybe you can talk about the cost.
Okay. Thank you. Just a great question on the cost-income ratio. As you noted, we made significant progress on the cost-income ratio. Having said that, right, we do have 60 branches. Oman is a large geography. So, we do have physical presence. And the industry itself operates ballpark at 40-45%, anywhere between 40 and 43%. So if you asked us, where we see cost-income ratio, one thing that the CEO and I are very cognizant is that we do not manage the bank by quarter. We try and make decisions. We have a 5-year plan clearly defined. We know what our financial goals are for the 5 years. We try and work towards that. So will we continue to make progress, as much progress on the cost-income ratio, and bring the cost-income ratio to 30s. No, that's not the aspiration really, right? In this market, we don't want to give too much of forward-looking data. But if you ask me ballpark where I see cost-income ratio in the next few years, I'd see just around these, just around the 40% mark. Right? We should be very cognizant of long-term implications of investment, branches, and technology as well, and the requirements of that is how I'd see. But what we are focused on, Nitika, the other part of this equation obviously is our return on equity metrics as well. Right? That we're very focused on. Whether is it through addressing revenue in one quarter, or spending a little more in one quarter, that will play along as we go along. That's how I see it. Did I answer your question? Did you get enough from the CEO and I, please?
Yes, of course. I just have a follow-up question. The CEO mentioned on the ISKCON project. Could you give us more details on it? We've heard it's about 50,000 housing projects, if I'm not wrong. So could you just, explain, give us a bit more details about, what is the total size of the pie and how much could, NBO potentially gain from it?
I think over the life of this program, if I recollect, it's around 5 years. It's more than close to $5 billion or 1.9 billion Omani riyals. These are relatively small ticket size. We're talking, I think, between 60 to 80,000 K per loan. This is a scheme that was discussed between banks and Oman Housing Bank and Ministry of Finance, whereby Oman Housing Bank will have created already a portal. Customer apply through that, and then banks bid for that business or try to get that business. It's an initial phase, but I think there's enough pent-up demand. There's a long queue, a long waiting period at Oman Housing Bank. We understand it's a couple of years of waiting. So there's enough pent-up demand that this scheme aims at reducing that pressure. So we strongly believe that without any shortcuts in terms of the risk parameters or underwriting policies, it can create a good opportunity for the retail banking business. But not only that, because there'll be an overflow of business for the medium and small enterprises, the suppliers of building material, etc., because it will, enhance the business opportunities and the construction sector in general.
Great, thank you so much.
Thank you.
Hello.
Any other questions? Yes.
Hi, good afternoon. This is Bishan Bhalla from Vision Capital. Can you hear me?
Yes,
we can
hear you.
Yes, thank you so much for the presentation. Very insightful, and congratulations on a great set of numbers. Just had a few queries that I want to clarify. I just want to talk about the loan book split. Now, if I look at your loan book split, it's currently 59-41 corporate to retail, and I've seen the improvement over the years from sort of a higher 45% towards retail to almost 41% right now. If I look at the banking sector, and I understand every bank has its own strategy, the banking sector on average has a 64-36 split towards corporate retail. And as of what we understand, there's a cap on retail lending. If you could just give us your comments on sort of having a higher percentage allocation on the retail side, or is that a strategy the bank is well bought into, or do you see that shifting more towards the corporate side going forward from a risk perspective as well?
Yeah, so it's not a risk issue, but definitely a regulatory kind of split that is there. Historically, you're right, NBO focused more on the retail side, but over the past 3 years, the growth or the new business opportunities has continued to come from the corporate, in particular GRE and sovereign segments. I believe that 2024 will continue in the same tandem, where we see a lot of growth coming in from the corporate segment side or the institutional side, while the retail side will grow, but maybe not as fast as the institutional side. So that's the kind of our approach there.
Noted. Yeah, thank you. And second is, next question would be with regards to the CFO. If we could have some guidance for cost of risk, what is an optimal level? We've seen cost of risk decline. If you could just, what would be a comfortable level over the long term? Like I said, you're not here for a quarter. You have a very clearly defined strategy, and you've done exceedingly well to sort of live up to that expectation. What would be an optimal cost of risk for the bank in the long term?
Maybe I'll kickstart and then the CFO will continue. Again, I need to take you back in terms of what we've been doing the last 3 years. And the focus on the GRE segment was very key and very important. Post-COVID, or the year 21 and 22, our view of risks in the market was relatively high. Given the situation and given corporates coming out of the COVID situation. So our focus has been predominantly on the GRE element. And these tend to come relatively with lower yield because of the high quality. But we said we are happy to sacrifice the higher yield because we believe that this lower yield will offer us or will be compensated by lower cost of credit that you've mentioned. And again, over the last 3 years, this has been proven, and we continue to believe that this situation will continue for 2024. But I think the risk levels has substantially improved on the other corporate side, and we do see opportunities selectively in terms of underwriting the right risks on the corporate side, given all the things that are happening in terms of what I mentioned, in terms of the opportunities offered by this SCAN project, because it's not only funding the end user, the tenant of the house, etc., but the suppliers, the construction companies, etc., will all benefit from the value that will accrue there. So there are opportunities that can be captured. The other side of the private sector, in terms of the larger infrastructure projects that has been talked about as well, will definitely add value to the economy and opportunities for lending on that side.
Thank you. Bishan, hi. Hope you're well. Thanks for the questions. So, look, you followed us for a while. Right? We've gone from a phase where cost of credit way back in 2012-ish, 13 and all that, 10, 15 bips, very low cost of credit, right down to, 2020 being a very high year, then normalizing in 2021, 22, right? So when we look at our own internal targets, etc., we were looking at, a 30 basis points cost of risk for 2023, and we were broadly there, right? I believe there's not much room to go down further. Those ranges, over the long term, 20, 25 to 30 bips is a good number. But, obviously seasonality and what we've done thus far, which the CEO has explained over the last 3 years, it was not by accident that the government book grew, the GRE grew, and the other segments shrank, or we avoided construction. That's not by accident. It's a deliberate, it's part of our strategy to manage overall returns and turn around this bank al-Watani al-Omani, so which is what we've delivered. So that's where I see it.
But on the other side, we don't shy away from taking the right amount of provisions. We don't take shortcuts on that front. We believe our book is maybe, if not the most robust, is one of the most robust in the local markets.
Yeah, point well noted and very well appreciated, because we see it in the numbers. I mean, it's a high quality bank. You use the word prudent very often, and we can see that with the low NPL ratio, with probably one of the lowest restructured loans compared to the sector. So we definitely understand that. And I'll come to a further point on that. The next question would be with regards to your non-fee income. Now, that's one number we've seen stagnant over the past few years. While we've seen core income and overall income grow, non-fee income or other operating income has been mostly stagnant. If you could just comment on that, please.
Non-funded income, yeah. So again, certain reasons for that is some contribution of, let's say, trade business, the guarantees, etc., which is a major source of income, do come from certain sectors where we might not have risk appetite for it. So you'll find certain banks might be relatively higher, but then the asset quality is also an issue for them. Second piece was a conscious, prudent, again, I'm sorry to use the word prudent multiple times, but this is a fact in terms of the accounting approach for us. We take the more conservative approach, which is the right approach of amortizing any upfront fees that are related to loans, etc., over the lifetime of the life of the loan itself. This is something we instituted in 2021. It wasn't the case earlier. But again, this is clearly a prudent approach and is the right approach for that. So again, in terms of how we recognize fees, the sector has an impact on the risk appetite issue. It has an impact on the fee element. So there could be a potential stagnation, but it doesn't mean that there isn't much work that is happening there.
Yeah, no, I think well articulated.
All right. Thank you. And last point before I go back into and let my peers ask their questions, you mentioned the primary focus is on return on equity, just return on equity. And we have seen that number improve significantly. Now, going forward, if I look at, just by nature of the policy or the payout policy that the bank has adopted, it's a low payout policy for various reasons that we understand. And that means that there's always a higher equity base compared to what the bank could generally have. So in terms of ROE growth, it would have to come from significant bottom line growth because you have a 4.5% loan growth. Your expenses are as good as they get. You have a provision number which is pretty much stable. There's not much room for improvement there. Dividend payments are sort of curtailed for obvious reasons, and hence you have an equity base which is on the higher side. So ROE sort of improvement, where does that come from? Or let's say if it were to go up another, let's say 200 to 50 bips or 400 bips over the next 3-4 years, where does that come from?
So I'll start with the macro level, and again, I'll let the details for specifics for Giri again. So it doesn't mean that we are stopping on the NFI piece. As you're aware, we have a very strong brand on the wealth side called Sadara. We are rebuilding and augmenting our investment banking proposition. So that's adding an element. We did not talk in detail about our Islamic banking side. Again, last year we started, you would have noticed a more focused and alignment of the Muslim branding strategies to NBO strategy. This should also start bearing fruit because virtually the fees there were, or even the NFI there were, the NII revenues there were very, very, very low. That's one part of the element. The second piece, in terms of active recovery side, there's an enhancement in terms of our approach on recovering even old NPAs, be it here in Oman, UAE, as well as even in Egypt. We started, having teams visiting all these geographies to ensure finding all avenues of recovery. So all these three elements are our tools to enhance our ROE perspective. Growth in the loan side only is a big consumer of RWA and capital as well. So we're trying to be more nimbler there.
Yeah, thank you. Bishan, look, we've had a bit of a chat around this in the past. Firstly, when the CEO and I looked at the dividend payments, we felt that post-COVID there was a need to adjust the payout ratio and adjust market expectation around that. And that was in line with what was happening outside as well regionally. But slowly but surely that tide is turning. But from our perspective, when you say, look at the capital and you're going to be high capital, you look at the Omani banks. Omani banks tend to be well capitalized. Perhaps a bit 16% is the norm here, right? A total CAR, and 12 is not, in my opinion, way above what the others are operating at. Okay, so we prefer the 11.8 to 12.2-ish, for CET1. So those two comments I'd make. Thirdly, the comment on ROE, plenty of avenues, right? Clearly, as we improve profitability across the bank through a combination of top-line growth, and I've mentioned this, right, in the past, and the CEO just mentioned it. We are focused week after week. The CEO and I sit down with the businesses, looking at net interest income, looking at opportunities to grow the fee income. Yeah, there might have been a little bit of a area for improvement, perhaps in some of the areas. But that said, overall, you've got to look at it overall. What are we doing? Clearly, the strategy is one of the 9 pillars is revenue, and the other is optimization. The third is the asset quality that the CEO alluded to just now. Those are our levers in terms of improving the ROE, and also the conversation that we are having with the board reflect a 5-year plan, right, in terms of steady improvement, not volatility, bringing volatility into the numbers. That's not what we intend to do. Okay.
Noted. Thank you so much, gentlemen. Wish you all the best.
Thank you. Appreciate your wishes.
Any other questions?
Hello?
Hey, Joyce,
Yes,
yes,
go
we
ahead.
can hear you.
We can hear you, Joyce.
Yep. Thank you for the presentation, gentlemen, and congratulations on the good set of numbers. And just a few questions on the first one is on your liquidity position. Can you please provide some more color on your liquidity position? Because I'm seeing the CASA ratio is getting tighter a little bit in 2023. So what's your target there on the CASA side? And we have seen significant improvement in your loan to deposit ratio. So where should we model the bank in terms of its LD ratio going forward?
Sure. So on the CASA piece, and then I'll ask the CFO also to comment on the LD ratio. On the CASA piece, I think the interest rate scenario in the country has substantially changed. That caused a shift overall for people away from the low-cost deposit, which is mainly CASA, to benefit from the higher rates into tying up their deposit at a higher rate with term deposit, etc. So this is a sector issue rather than only an NBO issue. And also for us as bankers, we need to manage the asset liability side. And as a consequence of the restructuring that you are aware of that happened over 21 and 22, a lot of lending to the private sector have been elongated. And to manage that piece, you also need to build a relatively longer term liability side to manage the risks that are there. So it was a bit imperative to sacrifice our CASA ratios that were quite high earlier on to a lower level, but prudently manage those other pieces. I think we're in a comfortable position, but definitely we want to go back to somewhere the earlier level. But at this stage, the MAL piece, which is the asset liability management piece, and is very important as well.
Yeah, I think that's what I add. Yes, thank you. Hi, Joyce. So I agree with you, but as the CEO mentioned, right, as the interest rates are higher, obviously you'll see a shift in the economy of people wanting to lock in the higher rate rather than get paid in CASA. That's one. In the past also, where we talked, I can't remember whether it's a 21 or 22 call, the CEO talked about the need to manage the balance sheet and manage cost of funding and how week after week we were doing it internally, right? Which is to say that would I pay 5% or 4.5% for a call deposit and still call it call or CASA, where current and savings account when I say CASA? Or would I lock that 4.5% in a time deposit where I can get the MAL benefit as well, maturity of asset liability. So that's something that we've spoken to all of you maybe 12, 18 months ago. So I think, if you ask us today, we've been following the same strategy. Having said that, there's been, a bit of increase in funding cost over the last 2 quarters of 2023. We are hoping that the market will stabilize during the first 2 quarters of 2024. Obviously, nobody's got a crystal ball. Certainly, we don't have a crystal ball which talks about the interest rates in the future, etc. Right? But from our perspective, those actions really resulted in a lower CASA number. We are focused on that. You remember we also talked to you about withdrawal of the price money scheme for CASA earlier on, or the central bank had withdrawn that savings account, not CASA, for savings account. Those do affect the CASA ratio, but we're confident that we'll get that back during the next 12, 18 months. That's the first one. Your questions were also on the liquidity position and LDR. We are liquid, as we mentioned, because of the growth that we experienced, particularly in Q4, where we had some repayments of loans as well. That clearly exacerbates the liquidity. We manage this on a weekly basis to see what the optimal ratio is. If you look at 2022, our loan to deposit, end of 2022, our loans to deposit was about 115%. We finished the year 2023 at 102%. Now, loan to deposit ratio is not the only metric that we look at. We look at a CBO mandated ratio called lending ratio. Then we look at the Basel III ratios as well, right? It's important for all of us to understand that, we look at LCR, NSFR, all of that. So liquidity is a combination of not just the old-fashioned loan-to-deposit ratio and lending ratios, but a combination of LCR and NSFR as well, which we manage.
Especially that given the interest rate scenario that is prevailing not only locally but globally, this becomes more imperative because you can go wrong using simply just LDR as a parameter or a parameter for measuring the liquidity piece. It might mask certain risks that are there given any volatile shifts, because if we just go back with the global chatter or media chatter about interest rate, we were expecting rate cuts coming in as early as possible. Suddenly everything shifted within 2-3 weeks that people are talking about delayed and potentially even rate hikes as well. So it is a quite volatile time, and it can go substantially wrong if you are dependent only on the LDR ratio. But like Giri has mentioned, LCR and NSFR are the 2 key parameters to be looked at.
Did we answer your question, Josh?
Yes, well and clear. Thank you very much for that insight. And we've been talking about the interest rates. So what are your thoughts on the interest rates and potential effect on the margins?
Okay. Like we've said, and I think Giri had reminded us all, we've instituted a weekly ALCO, which looks at the asset liability, the pricing of both assets and deposits. And the reason for that is it's not an easy meeting. It's a quite technical, very complex discussion that we have, and not because of the fun of it, but because of the uncertainties that are there around the rate environment globally. Usually banks do it on a monthly basis, but we've instituted it on a weekly basis simply because of this sudden changes that have happened, geopolitical situation, there's elections, there's etc. Different things and factors that are happening here and there. So we need to manage that situation. Our aim, also the rating upgrade that is happening to the country as well is putting some kind of impact on rates as well. So our aim for this year is ways of how do we ensure we have long-term funding at a very competitive rates that makes us competitive to take opportunities that are there in the market. Anything specific you want to go into?
No, I think we've answered that. I think look at Josh. We don't have a crystal ball to tell you where interest rates are heading. And as the CEO alluded to, we were all talking about the Fed plot was clearly three interest rate cuts this year, but market got ahead of itself as it typically does, especially when the Fed governor said that he's going to or pivot towards rate cuts in December. Then that started expectations of rate cuts, etc. Now we, as the CEO also alluded earlier on, there are some quarters which say that interest rates are indeed next move maybe very well be a hike. That's a very small percentage of the market, of course. But what it says is that it's going to be bumpy. It's not a straight line, right? It's not a straight line. I think that's the piece that for us as a management team, we are working towards making ourselves agile. Our decision making, the ability to quickly change gears should we need to do. I think we've demonstrated that over the last 3 years, but there's more work to be done in this environment, is how we leave that, rather than sort of giving you a particular view on interest rates.
Simply what I mentioned about the 81, it was very easy for us to pay extra and finish that $300 million, but we've decided not to do so. We were able to lock in $135 million out of that at a very attractive rate at that juncture or that point of time, compared to certain benchmarks that were there, because even global banks who are raising money at 8.5%, 9%, right? And these are global banks. The reason for that, we are very conscious on whatever pricing we do, and that's the reason why we did not complete the rest of 165. We'll only do so when it makes sense for us, and we can deploy it profitably.
Yeah, and so even recently you saw the UBS issuance, right? After the Credit Suisse debacle, UBS did raise this year. From our perspective, does it make sense for us to issue 81 at 8.5%? No, we don't want to do all that. So we'll be very once again prudent and manage the bank for the medium term.
Also, last year in August and September, we had actually a $500 million EMTN that got matured. We did not tap the market because of the volatile pricing then. We were able to refinance it through relationship banks that gave us even a much better yield than what would a capital market transaction offer us. Of course, all these are being reconsidered to see whenever there's an opportunity for better pricing, better cost of funds, is always something that is on our agenda.
Appreciate it. And I totally agree that no one has a crystal ball, but your thoughts are very much appreciated. Thank you very much. Just to recollect, one point that you mentioned, your CET1 ratio. You said, did I hear it clearly? Like, you're targeting around 11.8 to 12%, 12.2%. Is that a comfortable level that you're looking at?
Yeah, that will be a good sort of total tier one is CET also slightly behind because we don't have other. I mean, 81 is a small component, so that's a good number to go with. 16% is where the car is. I think again, given the Omani bank situation, I think 16 is a good number as well, Josh.
And we'll never, give out dividend and then do a rights issue. So give with one hand and take away with the other hand. Again, our distribution and dividend policies will continue to be prudent to ensure that we reward our shareholder, but also manage our capital structure.
Sure. Thank you very much, and wish you all the best.
Thank you, Joyce. Thank you.
Thank you. We have Jasim. Jasim.
Salam alaikum, Jasim.
عليكم السلام اخي عبد الله والاخوان عليكم الله يخليكم. اسمح لي بدوني من عربك اخي عبد الله احسن اساس انه
حياك
الله يخليك.
حياك
اعتقد الارقام مالكم ما شاء الله واضحه والاداء مالكم اكثر من رائع مقارنه بكل البنوك. الحمد لله اداء جيده. ارقامكم خلال 3 سنوات من مسكت الاداره اعتقد الامور طيبه والحمد لله ان شاء الله هناك بالتوفيق. انا بس شيء بسيط بغيت اشارككم فيه. طبعا قلت بتكلم بالعربي على اساس انه يمكن اتمنى اشوف انفسترز واشوف يعني شباب دائما اقول هالكلام يعني يشوفوا هذه المناقشات لان اكيد المفروض يستفيدوا الشباب خصوصا الخريجين. وبظل اقول هذا الكلام اتمنى منك اخي عبد الله يعني عندكم في البنك مثل هذه المناقشات وشو دعوه بعض الاحيان لشباب متميزين عندنا في كليات الاقتصاد مثلا مجموعه معينه 3 4 يحضروا مثل هذه المناقشات. شيء جيد ان شاء الله بعد.
بننسق مع الكليات اذا حبوا يشاركوا. طبعا المشاركه مجانيه طبعا ما فيها اي تكلفه. ممكن اترجم بس عشان البقيه يفهموا. Mr. Jasim says this is a good opportunity for say college students, especially in the business and economics colleges to join and start getting a flavor of what financial performance is and what it means. So I tell them we are happy and welcome that, and maybe we'll endeavor next time to invite certain colleges and universities whenever we do such events.
Assalamu alaikum, Sheikh Kefalik. So I want to answer one question of yours. So I can give you specifics on the number of internships that we have taken into finance for this. So, for example, when people come to us, various people, right, known people say, there's a graduate who's doing ACCA, Omani, who's doing commerce and wants to do an internship, we immediately take them. So I can tell you that this year alone in my department, as I go out now, how many people are there? 2 people now in the team now doing internship. So at least 2 people now fresh, just do 3 month studies.
Yeah, and also Jassim, you last time when I wasn't here, you had a comment. I wanted to introduce you to Miss Aisha as well, another new star in the organization, augmenting our Omani talent in NBO as well. So you'll feel proud of the Omani talent in NBO, inshallah.
Abdullah, we are proud of your leadership and the young generation. I mean, in this kind of finance organization, wish you the best, inshallah. I've seen you in Dubai. You're joining the Dubai, this meeting. It was really nice to see you there. أنا بس دائما باخذ لك sorry to talk in Arabic because I think I wanted some other people in the local to be interesting. بغنهم يعني يكونوا لهم علاقة بالاقتصاد، يعني الاقتصاد هو مهم كثير سواء كانت البورصة مقدرين. وأتمنى بس تعطي ملاحظة بسيطة للإخوان الانفسترز العمانيين بشكل عام. مثلا القيمة السوقية، سعر السهم شوية نزل الفترة الأخيرة. أنا يمكن حسب أنتم يمكن توزيع الأرباح يمكن عاملين أرباح جيدة، لكن يمكن الإدارة أو مجلس الإدارة والإدارة التنفيذية شافت إنه بس بتعطي يعني جزء معين نسبة بسيطة، يمكن هو أثر على السهم. ما كان في إمكانية ممكن بالإضافة للكاش تعطوا مثلا بوند convertibles 2 years. فما أدري كان يمكن هذا إلى دور نوعا ما، وبعدين إلى دور في حقوق المساهمين بشكل عام على المدى الطويل، يعني على 2 أو 3 سنين. ما أعرف لو تعطيني شوية من يعني
تم هذه المناقشة باستفاضة في آخر مجلس أو آخر اجتماع لمجلس الإدارة، وطبعا هذا مشروط بموافقة المساهمين في الجمعية وأيضا موافقة البنك المركزي في نهاية المطاف. لكن رأينا هو أن لازم نوازن ما بين احتياجات المؤسسة من خلال أو من لتمويل النمو اللي حاصل خاصة من ناحية رأس المال، وأيضا الكم ما هي السؤال فقط أو ما هي النقطة المهمة، لكن أيضا نوعية رأس المال. فأحيانا في مثل ما يستخدم المصطلح الإنجليزي CET1 و Tier 2 إلى آخره. فمن المهم أيضا أن نوعية رأس المال يكون من أفضل النوعيات اللي هي CET1 وكابيتال. فعشان كذا ارتئينا أن أفضل حل عشان نوائم ما بين النمو المتوقع خلال السنوات القادمة وأيضا إعطاء عائد للمساهمين أن يعني نتخذ هذا أو نعلن عن هذا التوزيع. أيضا ارتأى مجلس الإدارة أن ما نقوم بتوزيع كبير وبعدين بعد سنوات في إشكالية ثانية نرجع، لا العكس، علينا نظهر للمساهمين أن النمو حاصل. وأنت تلاحظ أيضا من ناحية حتى التوزيعات سنة عن سنة نزيد حسب الأرباح، وهذا السنة زيادة في التوزيعات تقريبا 20% مقارنة من السنة الماضية. فهي موائمة لاحتياجات مختلفة، في مساهم يبحث عن زيادة في السعر، في مساهم يبحث عن عائد سنوي كاش، فنحاول نوائم أيضا مع احتياجات المؤسسة أيضا من خلال تمويل النمو اللي حاصل.
من التوفيق أخي عبد الله أنت وزملائك، ما باخذ من وقت كثير، وشكرا على المناقشة.
الله يسلمك أخي جاسم، الله يسلمك، شكرا جزيلا.
Any other questions before we conclude the meeting? I think that's it.
Thank you.
Thank you, everyone. Thank you.
Thank you so much for attendance, and we'll see you next quarter, inshallah.